What's up, everybody? This is Zach, um, bringing you a little bit of a tutorial on cover call execution and also a little fam on how to use this cover call tracking spreadsheet. So this is take 2 of this recording, since I had the mic muted the entire time for take 1 with my dumbass. Okay, so let's see. This is the spreadsheet that I sent to everybody last night in BSI, and so let's just walk through this a little bit. So let's say I have a stock that I own shares in. In this case, I own 500 shares of OCGN, and my cost basis is $2. So my out-of-pocket expense is $1,000. Cost basis is $2. For now, we'll make this 0. And so my net profit obviously is negative, since I haven't made any money on the stock and I haven't sold any calls against those shares yet. So everything's in sync. So amount invested, $1,000, 500 shares that I own, $2 cost basis. My net basis $2, invested $1,000. Now in take 1 of this, I actually performed a cover call where I sold 5 contracts, and so the cost basis for those was 49 cents per contract. So I sold 5 contracts and I collected $245 at the $10 strike. The expiration is actually October 1st, so we'll take a look at that as well. So let's just look at what that does. So if I collect $245, so now my cost basis goes from $1,000 amount invested to the net invested is now $755, because I collected $245, and my net basis goes from $2 to essentially $1.50. So let's take a look at the actual trade. And so here's the option chain for October 1st, OCGN contracts, call contracts. Some people had a question about, or got a little bit confused about, how to sell cover calls on Webull. And so I just recommend not using this cover stock, because that does buying the stock and selling the calls all at once. And so I just recommend, for simplicity, just buying the shares outright, and then coming here and making sure you're on single option, and then all you're really doing is selling the calls at the expiration you want, the strike price you want, based on your criteria. So what delta are you targeting for that meets your criteria? Okay, so let's take a look at what I look for. So in my spreadsheet, so we've got some criteria, and the main thing is number 3 here. So the strike is above my cost basis. So in this case, my cost basis is $2, so I really want to strike above $2. But if I want to protect those shares and decrease the likelihood that they get called away, then I want to make sure I choose a strike that's out of the money. And so strikes that are out of the money would be strikes that are above the current stock price. And so you can look at deltas that are 0.35 or lower. So a delta of 0.35 means that there's a 35% chance of this contract at this strike price expires in the money. But as a seller, you're looking at the complement of that, so the opposite of that. So if it's a 35% chance of expiring in the money, and we want it to expire worthless, then that means there's a 65% chance of it expiring out of the money and worthless. And so you can choose 30.35 or something lower. The lower the delta, the higher the chance that it will expire worthless. and that's what we want. But the flip side of that is that the lower the delta, the less premium you collect up front. So just be mindful of that. Look at your criteria and see, what your profit targets might be on cover call premium, and make the decision on what strike price you want to choose. 30 to 45 days to expiration is what I normally choose. And so that's what I did. So day being September 1st, I looked at the October 1st options chain, and again, my criteria was 0.35 or lower. And so I chose the $10 strike, and at the time, I collected 49 cents per contract. So 49 cents per contract times 100, $49 per contract times 5 contracts, and that's where the 245 came from. So since then, the stock price has moved a little higher than when I entered, and so I'm showing currently negative on the P&L, but I don't worry about that. There's still quite a bit of time left on these contracts, so as long as the stock price remains below $10, eventually theta will start to eat away at the value of those contracts, and this will go more towards green and you become profitable. What this means right now, though, is if I wanted to close these contracts today, since I collected 49 cents per contract for them, and it would cost me more to close it, so 62 cents per contract, then I would realize a net loss of $63 if I try to close these contracts right now. But I just sit tight, and we let theta be our friend. So the longer the buyer holds these out of the money contracts and they remain out of the money, then theta will chip away at the value of these contracts over time. And so you can also take a look at what theta is for your particular strike price. So theta for this one is, times 100 is almost, $1.70. So $1.70 per day is what theta would be eating away at the value of this contract if the buyer holds it, or if, in your case, the seller holds it through expiration. If at expiration these contracts are still out of the money, meaning the stock price is still lower than $10, then you will realize all the premium that you collected up front. So in this case, $245. But just be mindful that you can close these contracts at any time if you wanted to. And so the way to do that on Webull, if I wanted to close these now, I just right click on it and I choose close 5 OCGN cover stock. But I'm not going to do that. I'm just letting you know you could. Okay, so that is what I do, and that's the conservative approach for selling covered calls. Some people run the wheel strategy, and so for example, they might be much more aggressive in the strike price that they choose. And so in this example, if the strike price is if our cost basis is $2, then they could, in theory, choose, a $4 strike or a $3.50 strike. They would collect, $435 per contract if they chose the $3.50 strike, which is much more than we collected for the $10 strike. But these are deep in the money strikes, which means that they are likely to expire in the money and get called away. And some people are okay with that, because if they're running the wheel strategy and the shares get called away, then they turn around and just sell or buy a cash secured put to set the price that they want to acquire the shares. And if that put expires in the money, they reacquire the shares at that strike price, and they can turn around and sell cover calls against those shares that they acquired. So that's the wheel strategy. What I'm talking about here isn't the wheel strategy. It's simply, if you've got a position with at least 100 shares, and the stock isn't moving or you're upside down, and you just want to collect a little money while you wait on that stock to turn around and start moving higher, then covered call is a way to make some money while you wait. So hopefully that explains. Well, let me just show you real quick, since I had done that in the previous version. So I mentioned the $10 strike. So if I wanted to actually sell a covered call, so this is my strike, and I simply right click on that. On Webull, it's different depending on who your broker is. I go sell, I choose a number, it defaults to 100, so I want to make sure I change that to the quantity that I want to sell. And there you have it. The premium you collect is also the max profit. So when you're selling options, the premium you collect is the max profit you can receive on the trade. Okay? So we collected $245. I'm not going to execute it since I'm already in the position. I just wanted to show you on Webull how you actually sell the call on the desktop app. It's pretty similar on the phone app, but I hardly ever use the phone app when I'm trading. So if we look at this now, let's see here. This is coming down a little bit, and so we don't panic. We just sort of let it do its thing over time. Eventually, as data kicks in, this will turn green, and we start realizing more and more profit, which is more and more of the premium we collected up front, which means that if this is green, that means that the current value will be less than what it was when we entered the trade, and will cost us less than what we entered to exit the trade. And the difference between the amount we paid to exit and what we received to enter is the profit that we realize on the trade. Okay, so that's what that would look like if you record it on the spreadsheet. So my first cover call with an expiration October 1st, I collected $245. What does that do to my cost basis? So instead of 100, I collected 245. So now my net cost basis is 755. Oh, my net investment is 755. My net basis is $1.50 per share. So let's say October 1st rolls around and the stock price is below our $10 strike. Then we keep this entire premium and we keep our 500 shares, and we can turn around October 1st and sell 5 more contracts with a November expiration date if we wanted to. And so you can see as you continue to sell covered calls on a month-to-month basis, you can eventually get to the point where your cost basis is 0, which is my case for OCGN. So I was into those 500 shares, about $1,000. I've collected over $2,000 in covered call premiums, and so it doesn't cost me anything to hold on to those shares, and I can afford to be a little conservative or aggressive if I wanted to. Just depends on what your strategy is. So let's say we're looking to sell another covered call that expires in November, and let's just say still going to sell 5 contracts, and let's say we're going to go a little higher on the strike price, which means that we're going to be collecting much less than what we collected in October or in September with the October expiration. So let's just say we're collecting 10 cents per contract. And so our total that we collect for November expiration is much less than the previous month because we chose a much higher strike price. We're gonna say that's 20 bucks, right? So we chose a much higher strike and we're collecting a lot less for that, but that's okay. So our total premium increases from $245 to $295. I'm just running an example just to illustrate what this would look like if at expiration with the higher strike price, if those shares get called away, what your profit would look like. Okay, so let's say we have 5 new contracts that expire in November. We collected 50 bucks. Now what does that do to our cost basis? So we look over here. So now our net investment is $705. That should be pretty straightforward. Our initial investment was $1,000, but we've collected $295. So now our net investment is $705. But collecting that additional $50 reduces our cost basis from $150 per share to $140 per share. Okay. Let's say November 1st rolled around. OCGN got some good news the day prior, and it just started moaning from $7 to over $20. What does that do to our bottom line? So if at expiration it's over our strike price of $20, then that means the buyer has the right to exercise that, to take over those shares. And in this example, let's say they do, and so that means we have to give up those shares, but we're not giving them up for free. We are making a boatload of money on the back end because our cost basis is so low, $2, our initial cost basis. The difference between that and the strike price is $18, and so times 5 contracts, that's going to be $9,000. So that's where the profit comes from. But we also collected $295 in premium. So our total profit, if the contracts get exercised as this $20 strike, would be essentially $9,300, which means that on our initial $1,000 investment, our return on that investment is 1,300%. You don't have to be a genius to realize that's just hitting it out of the park, right? So that's how you read the spreadsheet and can keep track of how you're reducing your cost basis over time. And if you go the conservative route, then you choose a higher strike price such that if the stock ever reaches that strike price, then you're going to collect big on the back end. Or you can be a lot more aggressive if you wanted to and just choose a lower strike and collect more premium up front. And the more premium up front, the lower the strike, then the higher likelihood that those shares get called away, which may be okay depending on your strategy. So I'll leave that to you to determine how you want to manage your covered calls, but this is just a brief overview of how to utilize this spreadsheet. And if you are a Webull user, how to enter and exit the trade, and based on your criteria, what strike price you'll be looking to target. That's all I got. We will post this in BSI. Hopefully you can take a look at it since somebody actually requested it. And then if you have any questions, you got a lot of smart people in the group that can answer those questions. So not just me, but several people in the group that are running cover calls and will be able to answer those questions. But I'll get this posted. Hopefully it's helpful. It is what you asked for, and hopefully you can combine this video with the commentary, the write-ups, and the posts to help you get started on your cover call journey. All right, peace.